Welcome back to the deep dive. Today we're dissecting a corporate transformation that quite frankly sounds like fiction. We're looking at a company that began its life in 1896.
Yeah, literally the 19th century.
Right. It started as a small shop called Park Seong-jik Store. And back when they opened those doors, they were selling face powder.
Yeah, or powder beer.
Exactly. And fast forward about 130 years to today, and I have a stack of research on my desk claiming this exact same entity is now manufacturing the neural pathways for the world's most advanced AI chips. We are talking about Doosan Corporation, but, I have to be honest with you right out of the gate. I am highly skeptical here.
I wouldn't expect anything less from you.
Yeah.
What's the main snag?
The snag is that just 3 years ago, around 2020, Doosan wasn't this high-tech darling. They were on death's door. I mean, looking at the capital flows and the macro picture back then, I remember the headlines vividly. They were in a massive liquidity crisis, just selling off everything that wasn't nailed down.
Oh yeah, it was a total fire sale.
Right. They sold Doosan Infracore, they sold Doosan Solus. It was all just to pay off suffocating debts. So my question for you, looking at this structurally, is simple. Is this AI hardware pivot just a desperate attempt to, slap a trendy label on a dying industrial giant? Or is there actually a fundamental change happening under the hood?
That is the multi-billion-dollar question. And to really answer it, we have to kind of look away from the stock charts and step inside the clean room. Because if you look at the raw data of what Doosan is actually manufacturing right now, it's not a rebound. It's a total identity laundry.
Identity laundry, I like that.
Yeah, they aren't bending steel in a heavy industrial factory anymore. They are formulating these advanced chemical resins that have to withstand heat that would literally melt normal electronics.
Okay, that is a bold claim. You're saying this isn't just an old dog performing a new trick to get investor attention.
I'm saying it is a complete structural inflection point. And to prove it to you, we need to dissect three distinct things: the accident of their history, the hidden technology inside what the market dismissively calls copper plates, and the governance war that's happening right now.
Let's start with the history then, because usually from a macro perspective, when a company is forced to sell its crown jewels, that's the beginning of the end. Take us back to that 2020 crisis. How bad was the leverage, really?
It was pure survival mode. Doosan had spent decades expanding into construction and heavy industry, but by 2020, the leverage just killed them. They had a debt-to-equity ratio sitting around 270%.
270? I mean, that is practically bankruptcy territory.
It's completely suffocating. To survive, the creditors basically forced them to strip the company to the bone. They sold the construction equipment arm, Infracore, they sold the fuel cell business, and the market looked at what was left of Doosan Corporation.
Which was just a holding company, right?
Basically, yeah. A holding company with a business making copper laminates. And the market just shrugged. Investors literally called it a copper plate company.
And copper plate sounds like a commodity. It sounds low-tech, low-margin, just selling metal by the pound.
Exactly. That was the widespread perception. But here's the paradox. By selling the obvious, shiny assets, they were forced to focus on the ugly ducklings that got left behind.
The ones nobody wanted to buy.
Right, which were the Electronic Business Group, or Electronic BG, and Doosan Enerbility, which focuses on nuclear and gas turbines.
So they were stuck with them, meaning they had to actually make them work.
Precisely. And then the macro environment just handed them a lottery ticket. 2023 happened. Generative AI exploded globally. Nvidia's GPUs became the most valuable commodity on Earth. And it turned out those GPUs couldn't just run on standard circuit boards. They needed a very, very specific foundation.
Okay, so this is the pivot point you mentioned.
Yes. As those chips got faster, signal loss became a killer. You needed low-loss CCL, that's copper-clad laminate. And globally, only two companies could actually meet the extreme technical specs for those high-end AI accelerators. One was Taiwan's EMC, the other was the company everyone thought was just making cheap copper plates.
Doosan. Wow. So the asset they were stuck with turned out to be the golden ticket.
And the numbers prove it wasn't just blind luck. In 2024, Doosan qualified as a primary supplier for Nvidia's Blackwell GPU series. They actually displaced competitors to secure that spot. And if you look at the margins, and as an analyst, this is the key indicator for me, Electronic BG's operating profit margin, the OPM, hit 29%.
Wait, hold on. Let me stop you right there. 29% for a manufacturing business. That doesn't make any sense. Traditional manufacturing usually sees single digits, maybe low teens if they are incredibly efficient. 29% is software territory.
That is exactly why you should be paying attention to this. Competitors like EMC are sitting at 15 to 18%. A 29% margin tells you they aren't just bending metal. They're selling a unique proprietary technology that gives them massive pricing power.
I want to drill down on that because low-loss CCL, I think a lot of us hear circuit board, and we just picture that flimsy green plastic board inside an old remote control. Why is this specific material so important that Nvidia is willing to pay a premium that generates those kinds of margins?
Think of the AI chip, the GPU itself, as a Ferrari. It's designed to go incredibly fast. But the CCL, that is the highway the car drives on.
Okay, standard analogy, but Ferraris can still drive on normal roads.
Not at top speed. In the deep tech world, we deal with something called signal integrity. As you push massive amounts of data through the chip, the electrical signals become incredibly fragile. If the material of the board has high resistance, or what we call dielectric loss, the signal just fades. The data literally gets lost in the plastic.
So the supercar actually has to slow down to make sure the data arrives intact.
Exactly. If the road is gravel, the Ferrari is useless. But there's a second, more intensely physical problem: heat.
How much heat are we talking about here?
Nvidia's Blackwell chips generate around 700 watts of heat. That is intense. It's like having a high-powered space heater concentrated onto a postage stamp. If you use standard materials under that kind of thermal stress, the board will warp.
And I assume even a tiny warp is disastrous when you're dealing with nanometer scale connections.
We're talking about microns. If that board warps by even a single micron, the connection breaks. The chip fails entirely. It's a huge yield issue. Doosan isn't just selling copper. They are selling a resin formulation recipe. It's a highly guarded chemical mix they've developed over 30 years that perfectly balances heat resistance with electrical insulation.
That's the moat then. It's not the manufacturing equipment, it's the recipe itself.
Precisely. You could go out and buy the machines tomorrow, but you cannot buy 30 years of trial and error in chemical mixing. That is why they have the pricing power. They're the only ones who can keep the road perfectly smooth while it's literally on fire.
Okay, that brilliantly explains the electronic side and those crazy margins. But let's look at the other ugly duckling you mentioned earlier. Doosan interoperability. This is the energy side, nuclear power. How does that fit into an AI story? Are they just pouring concrete for power plants?
It is the second half of the equation. We often hear interoperability described as a construction firm for reactors,
Yeah.
but I much prefer the term nuclear foundry.
Nuclear foundry. That implies they're manufacturing the core tech, not just doing the civil engineering.
Correct. Doosan Interoperability is one of the very few companies globally that can actually cast and forge the massive pressure vessels needed for nuclear reactors. And the business model here isn't just build a reactor and leave. It's all about the lock-in.
Explain the lock-in for us.
Once Doosan installs a gas turbine or a nuclear reactor, they basically have a monopoly on the parts and service for the next 20 to 30 years. You can't just swap in a generic third-party part for a nuclear reactor.
Right, the safety regulations would be a nightmare. So it's the classic printer and ink model, but operating on a gigawatt scale.
We call them long-term service agreements, or LTSAs. These generate highly predictable margins of 20 to 25%. It's incredibly steady cash flow. And with the rise of SMRs, the small modular reactors, Doosan has positioned itself as the primary manufacturer for global designs like NuScale power.
So they are building the engines for the next generation of nuclear energy. But let's try to connect the dots here. We have fancy circuit boards on one side and we have nuclear reactors on the other. They seem totally unrelated on the surface. Why does keeping them under one corporate roof make any structural sense?
Because they're ultimately solving the exact same problem from two different angles. Think about the biggest bottleneck for AI development right now.
It's power. Data centers are sucking the grid completely dry.
Correct. A standard data center uses a lot of power. An AI training center uses an obscene amount of power. Tech giants like Microsoft and Amazon are quickly realizing that the legacy grid cannot support their growth. They need on-site, totally reliable, carbon-free power.
Which inevitably brings us back to nuclear.
So look at the structural picture. Dot number one, data centers need advanced chips, which creates massive high-margin demand for Doosan CCL. Dot number two, those exact same data centers need massive electricity, creating demand for Doosan Interoperability's nuclear tech.
Wow. It's a closed loop. Doosan provides the materials to build the AI brain, and they provide the power plant to keep that brain alive.
And don't forget the wallet in this family, Doosan Bobcat.
The construction equipment guy, I forgot they still had that.
Oh yeah, Bobcat is the cash cow. They generate steady billions in revenue. That cash flow fundamentally funds the immense R&D required for the high-tech electronics and the massive capex for the nuclear projects.
So Bobcat pays the daily bills while the other two reinvent the future of the company. That is honestly a much stronger structural position than I expected. It's basically a portfolio of mini monopolies.
It really is. But we have to be realistic here in our analysis. A structural shift doesn't mean there aren't heavy risks involved. You mentioned being naturally skeptical earlier. What is the glaring red flag for you?
Well, setting aside the fact that these legacy conglomerates are notoriously hard to manage efficiently, the first thing I look at is raw materials. You kept mentioning copper. Copper-clad laminate. Copper prices are highly volatile globally. If copper spikes, doesn't that just crush that beautiful 29% margin?
It's a completely valid concern. Copper makes up a huge chunk of their base cost. But this goes right back to the pricing power concept we discussed. Because Doosan and EMC are effectively a duopoly in this ultra-high-end market, they have significant leverage.
They can just pass the cost straight on to the buyer.
They have been doing exactly that. The stability of that OPM, staying near 29%, even as commodity prices fluctuate wildly, proves they can pass those costs down to customers like Nvidia. Think about it. When you are buying a $40,000 AI chip, paying a few extra dollars for the foundation board that ensures the chip actually works is just a rounding error.
Fair point. The yield is what matters to Nvidia. But let's tackle the real elephant in the room here. The governance issues. Now, we are strictly looking at fundamental changes, not giving investment advice, but we have to talk about the sheer noise surrounding the merger. Doosan tried to merge Bobcat into Doosan Robotics recently, and shareholders were absolutely furious.
Furious is putting it mildly. It was a full-blown revolt.
Yeah.
The idea was to take Bobcat, the cash cow we just talked about, and merge it with robotics, which is framed as a future growth engine but is currently losing money. Shareholders saw it as severely diluting the intrinsic value of Bobcat just to prop up the robotics division.
And they had to withdraw the plan in 2024, right? So the deal is officially dead.
The deal is dead, but the structural impact of that fight is very much alive. That failure was actually a period of constructive pain for the company.
Constructive pain. Come on, that sounds like corporate spin to me, like saying, we messed up, but it was good for our character.
No, seriously, look at the resulting incentives.
Yeah.
It violently forced management to realize they cannot just bulldoze minority shareholders anymore. It pushed them toward actual shareholder-friendly alternatives. Because of that pressure, there is now a very high likelihood of a major treasury stock cancellation.
Let's break that down for the audience. I hear treasury stock cancellation a lot in capital markets, but what does it actually change structurally for someone analyzing this company?
Imagine the company is a pizza sliced into 10 pieces. Doosan currently holds about 1.6 slices of that pizza in their own treasury, meaning the company owns them, but those slices don't do anything. They just sit there. If they formally cancel those shares, they're essentially throwing those dead slices away.
So the pizza is now only 8.4 slices total.
Exactly. But the overall size of the pizza, the company's total fundamental earnings hasn't changed at all. So the remaining slices instantly become bigger. Structurally, it automatically boosts metrics like earnings per share and return on equity.
It signals a fundamental change in behavior, that they are getting serious about returning value rather than just endlessly shuffling assets around to maintain control of the family empire.
Precisely. It actively works to break that traditional holding company discount narrative. It tells the broader market that the cash flow actually belongs to the core operations and the shareholders.
Okay, so the governance noise might actually flip from a systemic risk to a structural catalyst if they handle this cancellation right. What about the third major risk? Competition. Whenever I hear manufacturing at scale, I immediately worry about China. Can't Chinese firms just dump cheap versions of the CCL into the market and destroy the margins?
In the legacy, low-end markets, sure, standard circuit boards are a brutal race to the bottom.
Yeah.
But in high-end AI infrastructure, geopolitics has actually become a massive protective move for Doosan.
You mean the ongoing trade tech war?
Exactly. Western big tech, your Googles, Amazons, Microsofts, and Nvidias are actively and aggressively excluding Chinese materials from their core supply chains. They absolutely cannot risk having a backdoor or facing a sudden supply cutoff in their critical AI servers.
So Doosan is heavily protected by simply having the Not China label on their tech.
That, combined with the sheer switching costs. For Nvidia to leave Doosan for a Chinese supplier, even if it were legally allowed, would risk severely lowering the yield of those extremely expensive chips. When you are in a dead sprint to capture a trillion-dollar AI market, you do not take risks with your physical hardware foundation just to save a few pennies on resin.
It really does seem like they have built a structural fortress here. But I want to get concrete before we wrap up. We've talked through the history, the tech, and the risks. If you are watching the space looking for fundamental changes, what are the signposts? What are the specific triggers that will tell you, okay, this structural inflection point is confirmed?
I have 3 specific triggers you should be watching for. These are the true inflection points.
Hit me. Let's hear them.
Number 1 is the Nvidia Rubin qualification.
Rubin, that's the architectural successor to Blackwell, right?
Yes, Blackwell uses the M9 grade material. Rubin will push the boundaries and likely require M10. If Doosan officially secures the primary supplier spot for Rubin, it proves that their margin growth isn't just a one-off lucky break with the Blackwell cycle. It proves they are deeply embedded as the long-term partner for Nvidia's future roadmap.
Okay, so watch the tape for that Rubin or M10 announcement. What is signpost number 2?
The Czech nuclear contract. We're currently waiting for a finalized binding contract for interoperability. If that ink actually dries, it creates a massive, highly predictable revenue stream that lasts for decades. It fundamentally validates the nuclear foundry thesis on a global stage, not just domestically in Korea.
Makes sense. And the third trigger?
The shareholder return policy we discussed. Specifically, look for official disclosures on that treasury stock cancellation. If they actually burn that roughly 16% of treasury shares, it changes the entire valuation math and governance structure overnight.
It sounds like a massive corporate maturation process, moving from a sprawling, confusing conglomerate into a highly focused, structurally sound tech platform.
That is exactly the goal.
Yep.
And if they hit those 3 specific marks, the fundamental transformation is complete.
So bringing this all back to where we started today, we have a company that literally sold face powder in the 1890s, survived a near-death leverage experience in 2020 by selling off its most obvious assets, and has somehow emerged as the critical backbone of the modern AI revolution.
It is a profound lesson in corporate adaptability. We so often look for AI plays in software and the flashy chip designers themselves. But the real bottleneck for the future of AI right now isn't the code. It is entirely physical.
Physical constraints.
It's heat and power. The chips are simply getting too hot to function, and the data centers are requiring too much electricity to build. Those are hard, physical engineering problems.
And Doosan is betting its 130-year survival on being the definitive answer to both of those problems. They provide the advanced heat-resistant skin for the chip, and they build the massive power plants needed to actually turn them on.
Exactly. They are positioning themselves as the ultimate gatekeepers of the physical constraints of AI.
That is a remarkably powerful thought to leave on. It really makes you rethink where the structural value actually sits in this massive tech boom. Is it just the brain, or is it the physical body that keeps that brain alive?
I would argue you fundamentally cannot have one without the other.
Well, for everyone listening, keep your eyes peeled for that M10 material announcement and any regulatory disclosures on those treasury stocks. Those are your clear indicators of fundamental change. Thanks for walking us through this deep dive into Doosan.
It was a pleasure to be here.
We'll catch you on the next one. Stay curious.